We have seen fantastic gains in 2025. We had about a 15% gain in the market. Depending on when you watch this video, it's either the final trading day of 2025 or early on into 2026. And so the question is, what's 2026 going to have in store for us? What are some good possible buys? What's the market going to do? Are we going to see another double-digit gainer in 2026? Are we going to see single-digit gains? Are we going to be flat for the year? Or are we going to see a pullback? So what we are interested in this channel is, can we find quality companies that we can hold and be confident in for the long term, that can survive any economic condition, that can survive inflation, recessions? So what we're going to look at in this video are 8 companies that we feel very confident adding to our portfolios in various amounts in the year 2026. We're going to score them, we're going to analyze them, and we're even going to compute intrinsic values to see what these companies are actually worth and to see if we are getting them at a bargain price. So before we get into that fun stuff, just a reminder, if you get anything out of this video, please consider subscribing to the channel, liking this video, telling your friends, telling your family, telling your mother-in-law. We're growing out this channel. We love spreading the good word about the awesome stock picks that we have. We like outperforming the market and picking quality companies that we can hold long term. If you're new to this channel, also just want to remind you that nothing that we say on this channel is investment advice. It's not financial advice. We're not telling you to buy, hold, or sell any of these companies in your portfolio. Always do your own research and due diligence. Now, what we do on this channel is we score stocks between -10 and +10, -10 being complete garbage, +10 being the best company in the world, 0 being a neutral sentiment. We want to be picky and choosy and discerning with our money, our hard-earned capital, and so we typically only look at companies that score 5 or higher. We are going to make the exception for Amazon today. And what we also do is we break scores up into growth scores and safety scores. Growth for companies that are going to grow and increase their share of their respective markets. Safety, they've grown, they've built themselves out, and now they're just returning capital in the form of dividends to shareholders. So we have all the scores here for the growth companies, and all the growth scores for all 8 companies. And just a quick rundown of what we're looking at for 2026. We have in many different sectors. We have EXEL, which is a cancer drug company, an oncology company. We have CDE, which is a gold and silver mining company. We have Micron, which is a chip company. NVDA, also a chip company. Johnson & Johnson, pharmaceutical drug company. Meta, communication services sector. They own Facebook, Instagram, Threads, the Quest VR headsets, all that good stuff, the Ray-Ban glasses. AOS is A.O. Smith. They are a company that build out water heaters and water softeners. And Amazon, we all know Amazon. They do Amazon Prime. They deliver goodies to our homes, and they are the backbone of the internet with Amazon Web Services. And so we can see their scores from top to bottom. Again, we're making an exception with Amazon. It is coming under 5, but we feel that the intrinsic value of Amazon in the coming years will be strong enough to justify that incorporating that company with such a low score. If we look at these growth metrics, Amazon, pretty decent numbers across the board. Debt to equity at 0.4, PEG ratio at 1.6. We like to see PEG ratios under 2. We especially like to see PEG ratios under 1. Amazon's in the middle of those. We'll call it good. 5-year forward PE at a 12.8. I do want to make a point about 5-year forward PEs and why we are so excited about that on this channel. So we are not stock traders. We don't swing trade. We don't day trade. We are in these companies for the long haul. And so when we invest our money, we are doing just that. We are investing our money. We are buying companies. We're buying ownership into companies that we have strong convictions in for the long term. And so when I say 5-year forward PE, I really do mean that we are looking at these things for 5 years. Okay. So Amazon currently has a forward PE of 30.3, which is okay, I guess. But if you bought Amazon today, the 5-year forward PE at 12.8 is showing that if you bought it at today's price, you're actually getting it at a 12.8 multiple of its earnings, which is quite fantastic for a strong, large company like Amazon. So that's why we emphasize this 5-year forward PE. It, of course, assumes this EPS growth, and currently for Amazon, it's 20.7%. If they can execute on that, who knows? But the 5-year forward PE for our purposes is a very important metric to look at to see, are we getting a deal for this company in the future, because we intend to hold these companies for long term. The only time we would really consider selling a company is if the fundamentals of that company changed. If they all of a sudden got some bad leadership, some questionable investments, some questionable business practices. Short-term pain is okay. If we see companies crash across the board because of short-term panic, we like to execute on that short-term panic. We like to buy those dips, get these stocks at steal deals, own those companies even more, and we're happy with that. But when the fundamentals of a company start to shift, that's when we consider selling. But nothing in our portfolio currently and nothing on this list is giving us any reason to think that management can't execute on a lot of these fantastic numbers that we're seeing. AOS, their standout metric is the free cash flow yield at 6.1%. They have a 5-year forward PE also at about 13. Very little debt to equity, 0.1, PEG ratio over 2, but AOS is not a growth play for today's purposes. It's actually a safety play that we'll see later. CDE is the silver and gold mining company. They're a core mining incorporated. Expected EPS growth for the next 5 years of 75.9%. That seems a little optimistic. We'll use numbers much, much lower than that in our estimates. As a matter of fact, I believe we're going to use 30% EPS growth for the next 5 years. And that's why we're seeing a 5-year forward PE coming in at 1.6 for this company. Also, very small PEG ratio, very low debt to equity. Same thing for Excelixis, that's very difficult to say. ROIC at 25%, very strong free cash flow yield at 6.6%. Johnson & Johnson, return on equity at 33.6%. Very strong very strong debt to equity at 0.6. Forward PE at 18.4, 5-year forward PE at 10.9, not a strong PEG ratio at 2.7. Again, we like that under 2, but Johnson & Johnson is the other safety play that we are considering in this video. Meta is coming in with a profit margin of 30.9%. That is fantastic. Revenue growth expected to be 15.9%. 5-year forward PE at 17.2. That's pretty darn good for such a strong growth company like Meta. PEG ratio could be a little bit lower. It's at 1.6, but debt to equity. A lot of these companies, especially ones that are starting to dip their toes into the AI space, we expect their debt to equity to start going up a bit, mainly because they're doing so much investing into chips and their AI infrastructure. So I would expect Meta to have a debt to equity ratio ticking up over the years. The other thing I will say about debt to equity is we like low debt to equity because we don't know what the future holds. We don't know what kind of economic or market conditions are on the horizon. And so we want to make sure that we invest in companies that have very low debt so that they can pay their bills, so they can survive a recessionary environment. So that's another reason we feature debt to equity on this channel. MU, this was a stock that was very good to us in 2025. We actually tripled our investment into MU. We tripled the value. That we'll see in a bit here. PEG ratio still 0.1. That is just a screaming buy. Forward PE at 7.6. If they can execute on 39% growth for the next 5 years, we see a 5-year forward PE at 5.4. A lot of people think that MU is done growing. They think that its best days are behind it in terms of its stock price, and we think that there's still a lot of room for growth for MU. Are they going to triple in 2025, or rather in 2026 like they did in 2025? Probably not, but we're still optimistic for MU. And finally, NVDA, you can see across the board just fantastic numbers. PEG ratio at 0.6, forward PE at 25.6, 5-year forward PE at 9.1, and we just see debt to equity, return on equity, return on invested capital, profit margins, revenue growth, all just solid across the board with a 38.5 expected annualized 5-year EPS growth. So fantastic companies for growth. We looked at their safety scores. Amazon, not really a safety play, pretty high PE ratio. It's why Amazon's also coming in with a low score at 2.1 here for safety. We see the best 2 safety scores are the 2 that have the healthiest dividends that we'll see in a bit. A.O. Smith coming in at 8.6, Johnson & Johnson coming in at 7.9. And here's A.O. Smith. They are actually a dividend aristocrat. They have grown their dividends for 32 consecutive years. They are growing their dividends at about 6.2%. That is way outpacing inflation. Their dividend yield is 2.1%, very respectable. Their PE ratio right now is 18.3. That's great. CDE, this is the gold and silver mining company, core mining. very, very good. I mean, if they can execute on their growth like we saw, a 1.65 year forward PE, their PE is okay at 25.5, very little debt to equity, return on assets 10.5. Excelixis, not a safety company by any stretch of the imagination, but they do have good return on invested capital and return on assets. Johnson & Johnson is the other main safety play in this video today. 63 years of consecutive dividend growth. That makes them a dividend king. 2.5% dividend yield, very nice, with a 4.7% dividend growth rate, outpacing inflation. And we just see respectable numbers across the board for Johnson & Johnson. And then the other three companies, Meta, Micron, and NVDA, also not really safety plays, but we see that they have some pretty decent numbers in terms of PE, debt to equity, return on invested capital, and return on assets. So the question is, what do analysts think about these companies? Where do they see these companies going? And what we're going to do is use our own intrinsic value calculators to see where we think the stock price is going for these 8 companies in 2026. So we will start with Amazon. Amazon didn't have the best year. If we look over the past year, we see that they are up only 4.32%. So they very, very much underperformed the market. But forecast, analysts see them on average $284 this time next year. That's about a 23 to 29% gain on average. High estimate coming in at $340. Analyst consensus is a strong buy. Core Mining, they've had a very, very decent year. They've actually tripled their stock price at 223% this past year. That is just phenomenal for this mining company. If we look at their forecast, we see that analysts are expecting between 10 and 26% growth on average, high at 37% growth at a stock price of $25 per share. Analyst consensus coming in at a strong buy. The oncology company, Excelixis, pretty much flat expected for the year. They're just in the middle of the buy consensus rating. The high estimate here is $60, and some analysts are thinking that it's going to plunge down to $30 per share. Alphabet, aka Google, you know Google, you're actually using it right now by watching this YouTube video. Analysts think that it's pretty much going to have a flat year in 2026. The high estimate coming in at $400 per share. That would be a 27% gain. However, the consensus on Wall Street is still a strong buy for Google. Johnson & Johnson, also flat expected throughout the year on average. High estimate coming in at about a 16% growth. In the low to middle range of the buy consensus for Johnson & Johnson. But this is a safety play. We don't know what 2025, or rather 2026, has in store for us. We do not know what's on the horizon. And so we want to have a company like Johnson & Johnson that are going to survive recessions, that are going to survive economic turmoil. Inflation doesn't matter. They're going to pay out a solid dividend like they have for the past 63 years. And so, yes, they are just a buy, not a strong buy, but we feel very bullish on Johnson & Johnson stock. Meta Platforms, Instagram, Facebook, all that stuff. Analysts think that it's going to be in the mid to low 20s gains. High estimate coming in at 68%. Strong buy consensus among Wall Streeters. Micron, it seems like Wall Street thinks that Micron has done all of its growing for the foreseeable future. However, there is a high estimate coming in at $500 per share, and that would be a 74.56% gain for Micron. The consensus among Wall Streeters is it's a strong buy, even with that average coming in at basically what the stock price is. And there are analysts that think that this is going to plunge 70% this year. Time will tell. We see fantastic numbers for Micron, and so that's why we are especially bullish on the stock and why we are featuring it in this video. And then finally, the darling of Wall Street, NVIDIA. Analysts average have it coming in the mid-30s, 32 to 33% on average. The high estimate, a $352 target price with an 86% increase. And some analysts think that it's going to come down to $100 per share, to 47%, down 47%. But the consensus on Wall Street is, of course, a strong buy. Everybody loves NVIDIA stock. Of course, there's its counterpart, AMD. We did consider featuring AMD in this video, but when we looked at the numbers and we weighed one against the other, we felt that NVIDIA was the stronger buy. Now, one of the most important tools that any investor can have in their toolbox is having a way of finding the intrinsic value. I mean, we just looked at Wall Streeters and their expectations for the year. They do vary wildly. Some analysts think that these stocks are going to plunge. Some think that it's going to go up 50, 60, 70% this year. And the question is, where do they get those numbers from? Where do they get these expectations from? And the answer is these analysts, by and large, for the most part, they run their own intrinsic value calculations. And so in the description of this video, I have linked 3 different intrinsic value calculators that we have built out on this channel. There's the PE multiples model that we're seeing here for A.O. Smith. There is the dividend discount model, really only useful for companies that offer not just a dividend, but a solid dividend that have promise of growing that dividend, and the discounted cash flow model. So all 3 videos are linked in the description of this video, so you can see exactly how to compute intrinsic values. And maybe you don't agree with my numbers. So for A.O. Smith, I'm using a growth rate of 6%, a discount rate of 8%, perpetual growth rate of 3%. If you disagree with those numbers, you can build out this Google spreadsheet yourself. Google spreadsheet is completely free to use if you have a Google account, like a Gmail account, and you can build out these models yourself, and then you can play around with the numbers and see what you think. So what we do is, for all of the 8 companies that we're looking at, we compute the PE multiples model, and we do the discounted cash flow model. And for Johnson & Johnson and A.O. Smith, we also compute the dividend discount model, and we average those 3 intrinsic values together. So for example, for the dividend discount model, A.O. Smith is intrinsically worth $143, but it's currently trading for $67. That gives us a phenomenal 53% margin of safety. So, what does that even mean? That means that somebody is willing to sell it to you for $67, but it's really worth $143. Okay, that is phenomenal. That's a steal deal. But that's the dividend discount model. We also need to look at the PE multiples model. Intrinsically, that's coming in at $184, and the discounted cash flow model, intrinsically $91 per share. So I encourage you to check out the links in the description of this video to see how to build out your own intrinsic value calculators. We're going to do that for all 8 companies, and if you stick with us till the end, I will give you a bonus company that is not featured in this video, that we don't do a lot of analysis on, but this company came across our desk. It's in a sector that we don't typically analyze on this channel, but we did want to feature it as a bonus stock if you stick to the very end. And before we get into it, just another reminder, if you got anything out of this video, if you got any value, please like and subscribe. Down in the comments, let us know, what are you buying for 2026? What are your hot stocks? What are your picks? Do you agree with these picks? Do you disagree? Do you have any questions for us? We'd love to know. So like this video, subscribe, tell your friends, tell your family, tell your mother-in-law. We'd love to have them all here as part of the Inner Flame investment community. Also, just another reminder, nothing that we say in this video is financial advice. We are not telling you to buy, hold, or sell any of these positions or anything else in any other future video. So we're going to go through these one by one in terms of score. So the first company that we will look at is Amazon. The average score is 3. We don't feel like the numbers for the future are really reflected in the current growth and safety scores, but they are coming in at a 3, something to take into consideration. The intrinsic value for Amazon is coming in at 306. They are currently trading for 231, which means that gives us a 24.6% margin of safety. So what we like to do on this channel is invest a hypothetical $100, and if that were the case, we would put $5 into Amazon. Of course, you don't have to think about this in terms of dollars. You can think about this in terms of percent. So however much money that we at Inner Flame are going to invest, we will put 5% of that into Amazon today. Second to last place is Meta, coming in with an average score of 5.55. We think that Meta is really worth $732 intrinsically. The current share price is $663, giving us a 9.5% margin of safety. We typically like margins of safety to be 20% and above, but we are making an exception for Meta due to its score above 5 and also its promise for future growth, that fantastic potential for that company. MU, the tripling of a stock price in a single year is probably behind us, but it's coming in with an average score of 6.05. The intrinsic value of this company is $453. Current share price is $288, so that gives us a 36.4% margin of safety. So far, we would put 5% of our investment into Amazon, 3% into Meta, and 14% into Micron. NVDA comes in next with a score of also 6.05. margin of safety of 41.5%. We think that NVIDIA can climb up to $332 in the near future. That is its intrinsic value right now, based on the PE multiples model and the discounted cash flow. If we were to put money into this company, we would put 16% of our capital into NVIDIA. Fifth is CDE, core mining, gold and silver mining, average score of 6.65. Currently trading for $18 per share. Intrinsically, we think they are worth $24 per share. So that gives us a margin of safety of 24.4%. We will put 10% of our investment today into CDE. Johnson & Johnson coming in with a solid score of 7. Remember, this is not a growth play. This is mainly in our portfolio for a safety play. However, it is coming in with a very healthy, respectable growth score of 6.1. Intrinsically, we think that Johnson & Johnson is really worth $317. Current share price is $207. That gives us a 35% margin of safety. We would invest $16 into Johnson & Johnson. A.O. Smith, water heaters, water coolers. We think that if there's some give in the real estate market, if we think people buy and sell houses again, if interest rates come down, then there's going to be a big need for updated water heaters and water softeners and all things that A.O. Smith makes. And so they're coming in with an average score of 7.35, mainly a safety play. They have a very healthy dividend growth. We think that A.O. Smith is worth $106 per share. They're currently trading for $67. That gives us a margin of safety of 36.5%. We would allocate $17 or 17% into A.O. Smith. And finally, the oncology company, the cancer drug company, EXEL, coming in with a very, very strong average score of 8.25. Their current share price is $44 per share. Intrinsically, they are worth $68. That gives us a 35.5% margin of safety. We will put 19% of our capital into that company. As promised, we have a bonus stock. This is a real estate company, a REIT. This is Vici Properties. What this company is a REIT that focuses on entertainment and hospitality, primarily in Las Vegas. And the reason why we don't feature real estate REITs, real estate investment trusts on this channel is that they don't typically follow the same business model as companies in the other sectors. So things like PE ratios, forward PE ratios, they don't really mean a bunch to REITs, mainly because of how REITs have to dole out their dividends. So what's more important for Vici is something called the funds from operations. So if you look at the the price to funds from operations ratio, which is kind of like the PE ratio, Vici is actually around 10, and historically REITs trade in the mid to upper teens. So Vici looks cheap right now. The stock price has been beaten down. Over the past year, it's down 2.8%. The past 5 years, not good at all, just up 11% in 5 years. That's way, way, way underperforming the market. We can see just how much volatility and ups and downs there are in Vici. But when we look at the forecast, what analysts think, so the consensus is coming in as a buy. But we see analysts expect it to grow between 23 and 24% on average, with a high estimate coming in at $38 per share. That would be a 35% gain. And what is especially attractive about Vici is their current 6.4% dividend yield. That is just phenomenal. So we like Vici here on the channel. We plan on adding more of that into our portfolio. It's something that we currently hold and that we plan on holding more of in the year 2026. So speaking of 2026, I hope you all have a wonderful, safe, happy new year. And I hope 2026 brings you and your loved ones a lot of prosperity, a lot of laughter, a lot of joy, and a lot of wealth building in your portfolio. So I appreciate you watching. Please like and subscribe if you get anything out of this video, and we will see you on the next one.